Hi, everybody. Thank you for joining us and welcome to Self-Directed IRA Tuesday. My name is Zach Wilson and I'm one of the IRA specialists here at Quest Trust Company. So before we get started, got to give you the disclaimer. Everything that you're about to see here is really for your educational purposes only. It's important to understand the role that Quest will play when it comes to your retirement investing. We're here to offer as many resources and as much education as we possibly can, and to really facilitate just about every type of transaction you'd be looking to make within your retirement account. But with that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investment. So a little bit about us, for those of you who don't know us. We are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. As of right now, we have about 20,000 active investor clients all across the country. We hold just over $2.7 billion in assets under administration, and we have over 100 employees, 34 of which are certified IRA service professionals. That means if you give us a call, no matter what, you're going to get a Quest employee who's going to answer and be able to answer who's going to pick up the phone and be able to answer any questions that you would really have. And if you want to take a deep dive into the nitty-gritty, more nuanced topics, we have a certified IRA service professional there to take that dive with you. And as it stands right now, we have over $400 million in undirected cash sitting in our clients' accounts. This represents opportunity. Whether you're an investor who needs funds to make their deal happen, or you're a current Quest client who's part of that pool, this is where your opportunity lies. But before you make any investment at all, what's always the first step that you have to take is to educate yourself. So take advantage of the resources we have, guys. Check out our YouTube channel. Check out our education center on our website. We have hundreds and hundreds of videos going over every type of topic you can think of, from the basics of a self-directed IRA all the way to the ins and outs of syndication investments and what that looks like and the implications that could have within your IRA. So really utilize those resources to narrow down exactly what type of investment that you would be interested in pursuing. And now that you found your investment, right? You're educated, you're ready to pull the trigger. Well, the investment's not just going to make itself happen, right? That's why you've got to start networking. Take advantage of all the networking opportunities we have. Join classes like you are right now, every Tuesday and Saturday at noon. Come to our webinars and come to our online networking happy hour on the fourth Wednesday of every month. But by far, our most popular networking event is going to be our self-directed IRA socials on the first, second, and third Tuesday of every month in Houston, Austin, and Dallas, respectively. Every single month, we have someone come out for about 30, 45 minutes. You get to just network with everyone there. And then we have a presenter who's going to present for about 45 minutes to an hour. And then after that, we get to continue networking, and we've even brought back deal pitching. So if you've got an investment ready to go, or you've got funds that you're looking to lend out, check out one of our socials and pitch your deal there. Right now, we're running a promo that gives you unlimited accounts for just $100. This is a very good value, guys, because this is where you can now open up that traditional IRA when you want to roll those funds from your retirement plan. You can open up the Roth for your kids so they can start getting some tax-free growth for their future. You can even open up that HSA that you had that you've been thinking about. You know you can take advantage of it, but you didn't really want to pay the costs associated. Now you get that account completely free. Just use our multiples 22. It's running all the way to the end of the month this month. And most important of all, guys, we're bringing back our Quest Expo. We are just over 30 days out from the biggest alternative asset investing event in the nation. As we're going to have over 30 speakers, over 40 sponsors that are going to be out there talking over a wide range of topics. This is not a self-directed IRA expo. This is an alternative asset expo. We're going to talk about private money lending. We're going to talk about inflation. And we have a panel that's actually going to talk about inflation and go over the role that alternative assets can play in your portfolio to help mitigate some of the losses that you're experiencing from this inflation. We're even going to have Dallas Cowboys running back Emmitt Smith coming out. He's going to speak. After he retired, he became a really successful real estate investor. So we're really happy to get his insight, and come present out to all of our clients and investors. If you see up top there, you want an additional discount, give an IRA specialist a call. You can use, for example, my code Wilson30 for an additional discount on top of that. All right. If you have any questions at all, you want to talk about your IRA, the Quest Expo, whatever it is, reach out to one of our IRA specialists. We'd be happy to help you out. But right now, I'm excited to go over the class that we have because what we're going to talk about is mitigating the risk when it comes to investing into things like a fix and flip. So without further ado, we have Larry Brand here to talk about mitigating those risks. Larry, you there?
I am, Zach.
Oh, perfect. So like I said to you before, I'm excited about this one, looking forward to this information. So with that, I'm going to give you the floor.
Me too. I'm excited to be here. Thanks so much for having me. I wanted to thank Quest Trust for the opportunity to speak to everyone today. And, I think Quest Trust just has a lot of potential for us at Planet, being able to utilize the IRA and for down payment for some of our investors. And so there's definitely a future for us working with Quest Trust. Quick little bit about me. I've been doing this for about 30 years. I was a fix and flip investor years ago. And so I understand, the nuances of buying and rehabbing and selling properties. And so kind of the pitfalls as well. And I got out of kind of doing the fix and flip and more into the lending side, which I want to talk a little bit about. And so, I think for me, the institutional lending came into play for fix and flip right after the financial crisis. So 2009, 2010, it used to be what we call country club money that was available for investing in fix and flips. Back when I was buying, it was 30 or 40% down payment. Interest rates were, 12 to 14 or 16%, and you were paying 3 or 4 points for your money, and you had to, use your own money to rehab the property. So pretty well invested as a flipper in the properties. And then the institutional money, kind of came around from Wall Street, and it's been really good for us as lenders, and also I think for fix and flip investors that are out there on this call. We saw a lot of interest rates, come down. I mean, like I say, we were paying 12, 14, 16%. And just, last year you're talking about rates in the sevens for a fix and flip, which is traditionally a riskier loan for lenders. And leverage went up. So, if you were putting 30 or 40% down in the past, now you could have done as little as 10%, even 6 or 8 months ago. So I think the institutional funds really, helped everybody out in the space. A lot of startups entered the space. A lot of lending startups entered the space, and some are still here, some aren't. But it was a great concept, and I think it's still a relatively new venture, having the institutional capital. I think that we can even make the process even more streamlined for fix and flippers. Securitization came into play. These business purpose loans is kind of how we coined the term now. So the business purpose kind of has fix and flip. It has DSCR, so rental loans for either single families or, up to 4 or 8 units, however you kind of, your model is. And then kind of ground up construction came into play a little bit, and that kind of followed this rental program. And then, I think things were going well for everyone through, as these institutional lenders were able to lend money, and kind of got the process down. There were certain boxes to check if you went to an institutional lender like us, but it certainly, you're not looking at income documentation or anything like that. So I think it's been great for everyone. And then we kind of hit COVID, and that was kind of a pause. Everyone stopped kind of lending at the time, and we saw really kind of even the institutional lenders go back to higher rates. Rates went up 10, 12%, pulled back on leverage. So you had to put 25 or 30% down, 20% down, even if you were an experienced investor, just because no one knew where, anything was going in terms of property values and interest rates. And so I think, rates kind of spiked, and it was almost going back to what, it was pre-institutional lending time. But that only lasted for a few months. And then as, things kind of loosened up with COVID, people were able to get out and see properties again, even if it was virtual open houses. And then interest rates dropped, right? So Fed went back to 0 rates. And so it was kind of off to the races post-COVID. 3-4 months after, leverage went, back down to where we can give 10% or 15%. The borrower would have to, put in. We'd give 90 or 85 or 90 on our side, and rates dropped again. So 21 was a pretty good year. I mean, supply chain issues were a factor, right? So a lot of the supply lumber, everyone kind of was in the news, and $100, $120, $150 for a piece of lumber, and people were trying to buy as much property as they could, or builders were trying to build as much as they could. So it was that supply demand kind of combo. So demand was high, wasn't a lot of supply with the supply chain issues that we experienced in 21. So you had to really still be on your game if you were a flipper or a builder, and manage your business, right? This is a business, and you have to understand it and take it as such. It's not just have all these fix and flip shows on TV, and it all looks so nice and easy, and they made 50 grand, in 2 hours. Just not the way it happens, and they don't understand the cost, and there's a lot involved in first finding the property, and then managing contractors, and then you have to flip it and sell it, and dealing with agents and real estate agents and buyers on the other side. So just a lot involved in that. So you still had to manage your business in 21, but look, buyers were lined up, right? Prices were increasing, and so you had a lot of people that were buying properties, and there were bidding wars even. So it was a good way to make a good amount of money. But then here we are in 2022, right? And so we've got some headwinds in the fix and flip game and the real estate game. And it started with rising interest rates. So the Fed came in and said that, well, first inflation was kind of rising, and so cost of everything went up: gas, food, everyone's seeing it on a daily basis, and the Fed trying to stem that tide of inflation and increasing, the Fed funds rate, and so accordingly rates spiked on the conforming loans, and so now you have less buyers or less pool of buyers for us as fix and flippers to find to buy our properties, and so that is a part of a risk that we're dealing with, and certainly our rates went up as these interest rates kind of spiked, and so the secondary market for us, where we tend to not plan it per se, we don't really sell our loans, we hold them on balance sheet, but other lenders were selling loans to the secondary market and securitization, and those things just dried up. So Wall Street wasn't really buying a lot of the fix and flip paper or this rental paper. And so rates really went up on those. And so, that 7% fix and flip rate is now 10.5 or to 12. Leverage kind of pulled back. So lenders are now saying, okay, well, you have to put an extra 5% into the deal. So now I can't do 90, maybe you have to do 85. Planet still does 90, by the way. Anyway, so, leverage pulled back, rates increased, less pool of buyers. And so there's risk there for us as flippers. And so, we've seen companies close, right? I'm sure you guys have read the news. There's been a couple of lenders that have closed that just got caught. They had, loans that were at 4% or 5% interest rates. And, within a couple of weeks, rates had spiked to 6-7%. So, those risks have to be managed. And now we have a smaller pool of buyers. So, of course, that's got to be managed on our side. And then, for Wall Street, getting back to that, they don't have really an idea either. So there wasn't an appetite for them to buy these loans because, quite frankly, they don't know where rates are going to be, right? They don't know if rates are going to continue to rise. They were battling that. So they increased rates on the fix and flip side, increased rates on the rental side. Those have come back down a little bit over the last few weeks and maybe last month, which is great. So kind of stabilized on the DSCR. The fix and flip, there's more appetite for on the secondary market. And that's just because, it's a short-term loan, and, Wall Street can kind of manage it. So there's still good return on it, right? So if you're at 0% Fed's rate and they're charging 7, great. But if they're at a 3% Fed rates and they're charging 10, they're kind of still making the same amount of money. But on the rental loan, that's a 30-year or longer, or actually not longer, but the 30-year loan, they don't have the ability to sit and know exactly what rates are going to be in the next 30 or 3 to 6 months. So that market got a little tighter. And so that's where you've seen some people that just haven't been able to survive. But thankfully things have kind of settled back down now. But we still have to manage the interest rate risk, right? Because our pool of buyers has been reduced. If a buyer was approved for a $400,000 acquisition, and that's what you thought you would resell your property at, well, they may only qualify for 250,000 now. So, kind of how do we manage that as flippers into our business model? And so, each of you out there, if you're flippers or thinking about flippers, you have to have a plan. And so, you have to just keep in mind that, the risk of the interest rate and your pool of buyers being less. So you might, on average, probably hold the property for 7 months. That may turn into 9 months. You may push into the whole 12 months that we enable you to have the fix and flip loan out. So interest rate risk is real, and it's here. Your cost of capital is going to increase just because you're paying the, a 10% or 10.5% rate instead of a 7, but it's nominal, right? It's just a short-term loan, so it shouldn't affect your business plan too much, but just making sure that you have another plan in case you can't find a buyer for your property. And so, that becomes, do you become a landlord? Not everyone wants to be a landlord. We get into the fix and flip because we want to make some profit, right? We see a house that's under market. We see the potential to fix it, and we see the potential to resell it and put, some cash in our pockets at the end of 7 months. So not everyone wants to be a landlord, but you may have to, right? We're seeing it in the market. People were probably flipping, I'd say, 30% of their properties, and the experienced guys holding on to 70. I'd say, last year, and you've got more, it's more 50-50 now, I'd say, where it's 50% of the people are flipping and getting out of the property if they can, and 50% doing it, a rental loan. But, look, a rental loan is a good option as a plan B. Most lenders at Planet, we can refinance you out after 3 months of you owning that property, fixing it, rehabbing it, and we'll give you the after repair value, so market value. So you're essentially pulling your cash back out of the property, taking your closing costs back, and possibly putting some cash in your pocket. Depends on where your credit score is, and how does the rent cover the expenses of the property, the taxes and insurance. But you could potentially do that and own a property and have someone paying your mortgage for you. Hopefully you would be cash flow positive on our plan, because you have to be. And so those are options that you have to think about. Or, if you're not interested in being a landlord, and, some people they don't want to get called at, 2 a.m. With a plumbing issue, right? So if you don't want to do that, then, it might be the other option is we're selling at either, break even, or hopefully not a small loss, but a smaller profit. And then you just kind of work to live another day and stay in the game and buy a property that's going to be a steeper discount now. Because prices are, coming down a little bit. And that just leads me to the second part of this, which is we have price risk now, right? Home price risk, where we don't know where kind of the values are going. Again, 3 to 6 month look forward, our price is going to be down 5%, 10, 20. You read a lot of articles, and there's a lot of varying percentages. But, clearly there are some really hot markets out there that are still hot. And so that's great, because you can still, make your money there. But there's other markets that have cooled off, and percentages have come down on resale. So that has to be part of your model, and looking forward and saying, okay, well, where is my market? And most of the fix and flip deals that are done, most of the flippers are local to their market, right? I'm in New York. Most of the people that I do business with are buying and selling here. So, they have a read on what their market's looking like. Are houses on the market longer? Yes. Have prices come down? Yes. Supply is still short. So there are still, people looking, but you're not going to have probably as many bidding wars as you had, in 2021. So you have to plan for that and make sure that that sale prices are coming down. With COVID, the foreclosures were kind of on that moratorium. So we will have more product coming on the market, right? So you'll have the ability to find more property, probably that's going to be, like I said, a steeper discount earlier. So you'll buy for a little bit less number now, and you'll be able to hopefully, put that into your portfolio and make up for maybe the properties that you bought last year that maybe you won't make as much profit on. So, I think that's part of the pivot that you have to make. You can't, overpay for properties. You have to have your model and just know if you're buying an auction property, you have a number in mind, stick to that number. If you're buying an MLS or you're buying from a wholesaler or you're buying from an estate, you have to have your number and you have to stick to that number. Don't get married to the property. Just, make sure you're sticking to your numbers and you'll be fine on the fix and flip side. I'd say we talked supply chain and rate risk a little bit. I think the other issues that you have right now is kind of, I would say, securitization for us. It's been disrupted a little. So, you've got to just be aware of that. You don't know where rates are going to be going forward. And if you're going to do a rental program, just know that for the rental, you have the income has to exceed the expenses. And with the higher interest rates, does the property kind of cash flow? So that's where we've kind of seen some more risk in, being able to say, okay, well, you're not going to flip the property, but you're going to hold it. And, now with the higher rate, if it was 3 or 4% last year and now it's 6 or 7%, does that property cash flow? There are certain programs out there that we're trying to work with and with you to help keep you, in that property. So for instance, if it doesn't work on a 30-year fixed rate, it will work maybe on a 5-year interest only or a 10-year interest only, where you're only paying interest on the front end of the deal. You're not paying the principal, but in the first 5 years of a 30-year loan, you're not paying much in the way of principal down anyway. So we qualify you there. Be aware there's going to be prepayment penalties on a debt service loan. So if you're going to refinance into a landlord loan, just know that there's volatility on the rate side, and that's going to affect your ability to kind of, hold on to that property or not. And so, some people have asked me, well, do I move into, other markets? And what I say to you, is this, or to them, is it can be tough, right? If it's an area that you can drive to. So if I'm in New York and I have one of my buyers that wants to buy in New Jersey or wants to buy in Philly or in Connecticut, great. You can try to learn that market, understand it, and kind of figure out what makes sense there. And, but you have to manage the property, right? So you still need to have someone, or boots on the ground, I guess to call it, where there's someone there that's watching the construction that's going on daily, right? You have to make sure that that's the project is moving forward. I've had some guys that have tried to kind of move in, from New York to Atlanta. It's tougher, right? They're not there daily. You have to fly there. You can't, drive. So if whatever market you're in, just know that if you're going to shift markets and try to expand, learn the local market, talk to the realtors, talk to contractors, talk to lenders, because a lot of lenders are lending nationwide now. Get an idea of what's going on in the marketplace. And if you feel comfortable enough and it fits your model, then, in your business plan, then by all means, try to dive into it. I wouldn't buy 10 properties. I'd start with one and then, see how the market goes and go from there. But it can help expand your business a little bit and, keep your profits where you need to be and get you to doing the number of deals that you need to. But keep in mind, leverage is lower, right? So if you're buying a $200,000 house and you were putting $20,000 down last year, well, now you're putting 25 or 30%, you're 30,000 down on that same house. So, was I buying 2 houses with 10% down and now I have to buy 1? Again, all kind of goes into your business plan, guys. So, but I would say just the plan is the biggest key, and sticking with it. I think, some of these headwinds are going to present opportunity, with foreclosures opening up, with rent, rates kind of stabilizing somewhat. I think you're going to see a lot of opportunity. I mean, fix and flip has been around. Again, I've been doing this 30 years. It's been around the same amount of time that I've been doing this and before me, and it'll be around after me, right? So there's still money to be made in each type of market. you just kind of have to be aware and shift and make sure you're following local trends. And so I think, you'll be fine. And I think fix and flippers can, continue to thrive, especially with, the more properties coming on the market that will be discounted. In terms of supply chain, I think that there's builders, as we see, they're kind of, pulling back a little bit, right? I think the builder, I forget what they call it, but there's a line that they look at, and some numbers that they have out there that have shown that they're kind of less bullish on the market, so they're not going to be building as much, and so hopefully supply chain it seems to be loosening up a little bit. So lumber prices have come down, right? And other prices, but what have they come down from? If lumber was 140 and now it's 100, but 2 years ago it used to be 50, it's not really down that much. But I think you'll be able to find the materials that you need, which is helpful. And I think you'll just have to manage your price point that you buy at. And we all know that in a fix and flip, we make money on the buy, right? We have to be smart on acquiring it. There's going to be hiccups when you're rehabbing it. You open a wall, you never know what's behind it. And then you don't know what resale is going to look like, especially now with the way rates are kind of working. So I would say just kind of stick to your plan, and I think you'll be able to avoid some of those pitfalls and those risks that we're kind of seeing out there. But you need to be aware of it, and and I'd say stay in touch with your lender. I mean, if you do start to see problems and you're bumping against 10 months that you're in your loan, your work's done, your work's not done. Make sure you're in communication with your lender, and letting them know is the better way to do it. Kind of not avoiding it, sticking your head in the sand or not answering calls or texts or emails is not the way to kind of combat that. We're your partner as a lender. And so, it's kind of good times and bad. So, we're your partner when you're buying your 2-3 houses a month. And if you're having issues on the other side, just, stay in touch with us. Do we have to extend the loan? Do we have to figure out, payment scenarios for you? So I think the more you can stay in touch with, with us, we certainly don't want to be in the foreclosure process, go into the foreclosure process. We don't want to be in the real estate business. We're lenders. So, what we want to do is we want to lend to you on your property. You get in and out of that, and then you come back to us, and hopefully we can lend to you again on the next properties that you're working on. Last thing we want to do is really kind of foreclose and take that property over and have to finish it. We will, but we really prefer not to. So Zach, I don't know if there was any questions on there, just take a breath for a second, see if there's anybody that had any questions on what we've kind of gone over.
So far, I'm not seeing any questions up there. Guys, in the chat, if you're watching the video, please utilize the chat, whether it's questions are going over specifically IRAs that we can address here on Quest side, or if they're questions specifically for Larry on the fix and flip side or the lender side, be sure to utilize that chat. What we'll do is we'll bring it up there. We'll have Larry answer it. But as of right now, Larry, no questions in the chat, so the floor is yours.
Okay. So, what I would really just, last kind of thing that I think I wanted to talk about was, and I've mentioned having your business plan and kind of knowing your market is, as a lender up front, we have a calculator that we work with. And so you should too. Like I mentioned earlier, where you have these TV shows that kind of show in a half hour that they bought the property, they rehabbed it, and then they sold it. It's all great, but there's a lot in between there. And what they don't show in many of these, when they put up there, they'll be like, oh, the purchase price here and, rehab here and sale here. Well, we all know there's a lot more that goes into that than just those numbers. And so you have the broker commission on the buy, the broker commission on the sell. You have carrying costs of your monthly interest every month. You have taxes, insurance. So there's a lot of costs involved in the purchase of the property and the sale. And so we have a calculator that, puts all those numbers into play and gives us a profit number. And so, minimally, generally we're looking at, does that property, is there $15,000 in profit, depending on the deal, right? I mean, if it's a $500,000 buy, we don't want to see a $15,000 profit. But, if it's $150,000, $200,000 buy and there's $15,000 in profit, then we kind of look at that, and there'll be an ROI, or return on investment, on that number as well. And so we can look at that and kind of see if it makes sense. So, if you don't have it, certainly, reach out to us. Zach will get our information out, and we can help you guys with that calculator. But you want to make sure you know where the numbers are. And look, real estate brokers are a great partner for us. And certainly we work with them, but they want to sell the house. And so that's great. But at the end of the day, you have to be the one checking the comps, making sure the resale's there, making sure the price you're paying today is the number that's right. And so what I would say to you is, if we're pushing back and saying, hey, this deal doesn't make sense, it would behoove you to kind of double check your numbers, maybe tell the realtor, hey, I have to make a new bid on this. I'm not going to pay, 150 now. I'm down to like 135, and see if you can renegotiate that. But, we're your partner for the long haul. And I think, we try to look at it as a lender that we don't want to make a bad deal. And so you should be looking, at the same numbers and making sure that you're crunching all of that. And certainly, again, with the interest rate risk, with the resale risk, not knowing where these things are going to be in the next 3 to 6 months, you want to make sure that that pencil that you have is sharpened, and making sure that you have all your numbers lined up, and that you're not really exceeding those numbers of what you're looking to buy at. So I think, for the most part, that's it for me, guys. I didn't know, Zach, again, if you had any, other questions, or if we missed anything, but that's kind of, I think, the risks that we're looking at in the market today for a fix and flip.
Awesome. So still nothing in the chat. Guys, ask away. I put your information in there. You can reach him at lbrand@planetrenovationcapital.com, and give him a call, 516-413-7400. Also, guys, if you have your IRA questions, reach out to an IRA specialist. We'll be able to help you. But if that's it, it looks like we have one from Leanne. I'll go ahead and show it up here, asking, how fast is your fix and flip loan closing and interest rate range for it?
Great question.
What is the interest rate range for it?
Yeah, super. Great question. And thanks for it. So yeah, I mean, look, we can close them within 6 to 7 days. It's a little bit of, is the borrower engaged, and, are they, getting us any documentation that we need? And it's not a ton of documentations, right? This is not a conventional or FHA or government loan that's out there. It's basically we're looking at the property. So, is the property, are you getting it enough a discount? Does the rehab budget make sense to get it back to market value? And then what you're looking to sell it for, is that in the range in the marketplace there for the similar house, right, guys? So a lot of times, make sure if it's a 3-bed and a 2-bath, the comps are 3-bed, 2 baths. If the square footage is 1,400, make sure it's around 1,400 in the comps that you're looking at, and make sure it's, within a mile radius of that house and where you are, and that's, the comps have sold within the last 6 months, because that's what we look at. So we can close them in 6 or 7 days, again, as long as that we can get an appraisal out, get title, contract, rehab budget from you. Those are most of the documents that we need. A few things on your experience, because we're going to look back for 2 or 3 years and say, hey, what have you done? And for us, it's 5 is the max experience that we have. You get our max leverage at 90 for 5 flips in the last 3 years. So it's just a matter of us kind of making sure that you have those 5 flips over the last 2 years. So we can get all that done while we're waiting for the appraisal and title. Those are the third-party items that we don't have control over. But anything that you as the borrower and us as a lender can kind of work on while we're waiting for those, we can get that looked at, and then we're just getting a review of the appraisal and a review of title. We can get it closed. And then interest rates, we're still at a 9 handle. So we're still at 9% for an experienced borrower, which is great, because I know that a lot of the competition is at least at like 10, 10.5, even for an experienced borrower. But you can see rates anywhere from R9 up to like, 12.5% now. For inexperienced borrowers, someone that's new to the business, can we still get a loan for you if you haven't done any flips? We can, but you're going to put a bigger down payment. So you're looking at 20-25% down on the acquisition, but you're still getting into the game, which is great. And your interest rate's going to be higher. Just, risk reward, right? For us as a lender, it's always going to be, we're going to be looking at what's, where's the risk and where's the reward for us. So that's about where the range are for, for rates and how fast we can close.
Awesome. We got another question from Jackie asking, do you have minimum loan amounts?
Sure. Yeah. Listen, I think combined, We don't want to be really less than 50,000. So, if someone's buying something for 20 and they have, 40 or 50,000 in a rehab budget, that would probably be the minimum that we would be looking at in terms of loan size.
Okay.
And then, you're looking at at the higher end, probably $1.5 million, 2 million. I mean, depending on where people are, right? If you're in California or you're in Los Angeles area or Beverly Hills, we know that, you're going to have a loan size of 4 or 5 million. So, certainly we can take it to that number. Anything over 5 million is going to be a little bit of a committee review for us, but we'll still take up those higher loan amounts as well.
Do you invest in all 50 states, or is there any states that you don't?
Yeah, there's a few. There are a few that we don't. We'll do some rural areas, but I want to say we're in 43 or 44 states right now. And then again, some of the rural areas you have to be careful. We can lend in rural areas, but leverage is going to be down, right? You're going to be putting probably 40% down on a just not enough pool of buyers for us in an area that's more acreage than not.
Yeah. Have you seen any trends as far as where you're lending to? Like, are you lending mostly in some states and really not seeing any activity in others? Or have you noticed any patterns?
Great question. Again, I mean, throughout the country, it's pretty active, but New York. I mean, well, let's talk Florida, Texas, Tennessee, very hot, right? Nashville, Houston, Austin, Dallas, Tampa, South Florida, Miami. It just, really, I think from what we've seen, still on fire. Still high prices are higher. Acquisition costs are higher. Rents are higher in all those areas. Just a lot of people moving there with the remote, people being able to work remote. So those areas still pretty hot. And the rest of the country is still pretty good, but we see softening in New York and in California, but we're lending New York, all the states, we're still seeing lending. Kind of like I said, Zach, it's, the fix and flip's not going away. It's a business that is here, that people have continuously done it. They're still going to do it. It's what they know. And so it's just a matter of kind of changing with the times. And I think, your profit margins are still going to be okay now. Even, like last year with the supply chain issues and the cost, increased last year, everybody kind of trying to get all that those supplies, they paid the price. And so your profit margin, was still going to be, I think will be the same last year as it is today, where, the supply chains have opened up a little bit, but you might be holding on to your property a little bit longer, today than last year.
All right. Another question from Jackie asking, what type of properties are allowed and what's not allowed? So condos, SFR.
Yeah. So we'll do condos. We'll do 1 to 4 pretty much on the flips is what we're doing. Townhouses. So those are the properties that we generally do. On the DSCR, we will do up to 8 units. So we'll do multifam from 5 to 8 on that. And then we'll do foreign national. We'll do short-term rental. So if someone's renting for an Airbnb and they're in an area for Airbnb, we'll do rental for that. We take a look at the short-term rental, which not a lot of places do. So we do have that out there. But 1 to 4 condos and townhouses are what we'll lend on for fix and flip.
Awesome. And we have a question from Bill asking, any thoughts on the upcoming foreclosure market?
Yeah, I think it's, you're seeing more foreclosures kind of coming through all the courts. And so I think that you're going to see auctions open up in a lot of states. We're seeing it here in New York. The auctions there's more properties that are being, put up on auction. There's people that are going out there and bidding on it. I think if you look at, auction.com and Realty Track, those guys are pretty big and they they do a lot of auctions online. You're seeing more properties come up on their sites and more bidding on there. So I think that it's going to get a little more normalized on the foreclosure side, just because, with the moratorium during COVID, nothing could really get through the system. And so as a lender, it was tough for us, right? We couldn't do anything really with the properties. And, same thing for buyers. It's really, really, really tight supply. So, I think there's going to be a lot of opportunity, Bill, in the foreclosure markets now and auctions, that you're going to see more and more properties coming up. Banks are going to be, able to get through the process of the foreclosure quicker. and able to get these properties on the market and sold. So yeah, it's coming, and that's why I say make sure that you're bidding at the right number and your numbers are in play for the market that you're in, because there's going to be opportunity for sure on the foreclosure side.
Absolutely. And correct me if I'm wrong, Larry, but the process will change whether you're in what judicial foreclosure state versus non-judicial foreclosure state. And
Sure. Yeah. The
when they
judicial
go
is going
through.
to be a little bit tougher, right? Because we're gonna go through the court process, and they're of
Yeah.
course going to give the buyer the opportunity. But look, if they've been behind for a while, it's it's kind of a foregone conclusion. But there's backlog, right? I mean, it's kind of now getting through. I'm in a judicial state in New York, and so it's
Mm,
they kept pushing the moratorium, pushing it, and so there's a lot of foreclosure filings that they just haven't gotten to, right? So you're probably seeing foreclosures back from COVID days, 1920, that are just first getting out here in 22 now.
yeah.
So, and I think, look, you've got a lot of inflation, and it's tough for people right now. And job market seems to be stable, which is good. So hopefully they're not getting into trouble. But I think you'll see a little more normalized foreclosure market in terms of if you're an investor and you're buying for a fix and flip.
Awesome. So when it comes to the properties that you're lending on, do you have any requirements? Like, I know some, like, I'm not going to lend on a 2-bedroom, 1-bath. I need to see at least a 3x2 home. Do you have any
Yeah,
requirements like that?
no, we don't. Because, again, Zach, the appraisal is going to kind of, help us with that. So we'll see what the area is like, right? If there's other
Yeah.
2-bed, 2-bed, 1-bath in the area, then we're going to be okay with that, and we'll lend on that. So yeah, no real restrictions in terms of that or square footage or anything like that. And we're looking, like I said earlier, at the property for the most part. So the appraisal is important. We're gonna want to see what the is the price that you're paying on the contract, is that as is price correct? We're going to get a look at the budget. If it's a larger budget, we might have someone do a feasibility study on it just to make sure that you're taking care of all the right things that you have to. If it's going to be a larger rehab, and you're seeing some lenders don't really want to lend on the larger rehabs now just because of the risk that's involved with that. But we're going to look at the budget and make sure that's in line, and then again we'll get what's called an after repair value on the appraisal, which will show what that market value will be once the repairs have been made to the property. And so we're going to look at that for the most part. Title, right? Is everything in line in title? Those are the things that we're really focused on when we're lending on these loans. And then, second is going to be, okay, what's your credit score like, right? So we will look at credit, and then we'll look at your experience. That's really the other key, right? Do you get the highest leverage? And to do that is going to be your experience. You have to show us, hey, are you getting in and out of your properties in 7 to 9 months or 12 months? Or is it taking you 18 months to get in and out of your properties?
Yeah.
And I'm not saying that 18 months is bad, but maybe you do, higher end work. I don't know. But we'll look at that. And then if you're new, then we're really going to kind of dig in and, what's your credit score look like? What's your background like? And of course you're going to have more leverage in it, or more money in the transaction. So, we're looking at the borrower, but we're not looking at income. I'm not really looking that much at assets. I'm not looking at all those things. Do I look at assets? Maybe, but I'm not, what's that, $10,000 deposit in your bank account? Like, we're not that detailed. We're just looking at, do you have the assets to kind of make the transaction happen? And if you're buying 2 or 3 or 5 or 6 houses from us, we want to make sure obviously that you're okay there. But for the most part, it's background, credit on you, and what's your experience look like.
Awesome. And I think that answers Jackie's next question. She's asking, what about a full kitchen, like an oven stove versus microwave and fridge only? And I think it's just, it's a case by case basis. It sounds like, right?
Well, it is, but I think you're going to want a kitchen.
Yeah.
So,
right.
Yeah. I think, for us as a lender, we're going to make sure that there's a stove in there and a fridge and things like that. And, you don't have to have a dishwasher, but you got to have a stove and a refrigerator.
Yeah.
In the kitchen there. Yeah.
All right. So that's all the questions for right now, guys. If you have any questions that inevitably, whenever we're done, something pops up, reach out to Larry. Again, his email is going to be lbrand@planetrenovationcapital.com. Give him a call, 516-413-7400. If you got questions on the IRA side, give us a call. Send an email over to iraspecialist@questtrust.com, or give us a call, 281-492-3434. Be happy to help. Until then, Larry, thank you so much. Oh, we got one more question. right before we go. That's Leanne asking, what is your closing costs for your fix and flip loan, and what is the charge per draw and turnaround?
Sure. So closing costs are going to depend per state, but per state, I'm sorry. But, for us, it's, on the lender side, it's generally like 2 points. And then there's, I think, a small processing fee. And then it's just closing costs, really. You pay the lender's settlement agent or whoever's preparing documents for the lender. And then, like I say, per state, it depends, right? I mean, New York's expensive. We have mortgage tax that's, if it's in the city, in Queens or Brooklyn, in New York, it can be up to almost 2% just on mortgage tax. So it could be a 5 or 6% of the loan amount in New York, but in Florida it could be less, right? It could be 3 or 4%. So you kind of, it's kind of state based, but nothing out of the ordinary. Charge per draw, it's generally somewhere around 175, and draw turnarounds where we really crush it. I'd say myself and other people on the, at Planet have done fix and flip. And so we get it, right? You're doing your work. You got to pay your contractors. They want to get paid. Otherwise they're walking off. So, we want to make sure that you're getting your draw money, but obviously we have to, get pictures done to make sure that the work's been completed. So, we send someone out, they take pictures, let's say, a day after you've called us, we get them back. And hopefully that same day we get the pictures back, we're sending out that draw. So usually it's 3 to 4 days for us to turn around a draw and get you your money wired back to your account.
Awesome. Do you have any like term limits on your loan? Like you won't, you don't want to see, past X amount of months.
In terms of, I'm sorry.
Yeah. So obviously, sometimes you need an extension on it when
sure.
initially, but is there like a limit that you'll hit that, we won't go past this?
Yeah. I mean, I think if we've got to go 3 to 6, months out, and extend that for you for 3 to 6 months, that's pretty typical. And we're not opposed to doing that. If it's a larger rehab, we might talk to you about doing an 18-month loan up front. But there's going to be a charge, it's going to be probably 1% of the, outstanding balance, for extending that loan. Just because we want to turn our money and we want you in and out of the property as quickly as we possibly can. But again, it's kind of what I said earlier, Zach, like, just stay in touch with us, right? I mean, we get it. Sometimes things get jammed up. And, like I said, we're your partner, through good and bad. So just stay in touch. Let us know, I need some extra time. But hopefully it's just a 3 to 6 month extension that you need. If you start getting beyond that, it's a little nerve wracking for us as a lender, but do we have to do it? I mean, listen, we're already in the loan, so we may have to stay with you on it, but I'd say the preference would be 3 to 6 months to extend it out.
Yeah. And I think it's one of the pluses that people don't realize, working with people like you, that you can call and ask, right. They can open that line of communication to where if they're getting like a big institutional loan from just some faceless, corporation, it's going to be, well, too bad.
Yeah, it's true. And I think that you're right. I mean, a lot of people as borrowers, they just some people just don't know how to communicate as well as others. And, I will tell you that, look, we work with both, right? But it's easier to work with a borrower that's kind of in communication with us and talking to us. And, they just let us know, hey, here's where I'm at. And that's the real deal. It happens, right? I mean, in a lot of cases, or not a lot of cases, but you have some cases where in fix and flip, you can really become kind of, excited about every deal. Oh, I got a deal. I can make, 60 grand on that one. And then another one came across my desk. I can make 75 there. But you have to be careful because you have to manage your cash flow and you have to actually finish the first one that you're going to make your 60 on, or finish the second one that you're going to make your 75 on. And sometimes, buyers get excited about buying and see the opportunity to make the money. But at the end of the day, you might be better off kind of slowing the pace down. But if it does happen and you're into 2 or 3 and you get jammed up, you got to just, reach out, talk to us. We understand that, cash flow might get tough for you, but that's why we said earlier, stick to your business plan, make sure you have one. The one deal that you're making the 60 on, finish that and get your money in your pocket. That other deal that's coming across your desk the next day at 75K, it'll still be another one down the road. It's, in 4 months when you're out of that first one, unless you have the ability and the cash flow to really buy, more than one property. And that's kind of where you come in, Zach, where you can help people, investors with the IRA buy more property.
Absolutely. So Larry, looks like that's it for us. Thank you so much for coming out. We really do appreciate it. I think it was really useful information for us.
Great, Zach. Appreciate you having me.
All right, guys. Again, reach out to Larry if you have any more questions at all. Reach out to us if you got IRA related questions. But until then, you guys have a good day.